Welcome to Bears in Exile. Today is June 5th. This is the first part of our weekend market overview. We have too much to go over to cover everything in one video. As always, we'll be going over the Dow, SPX, VIX, TNA, UUP, FXE, GLD, and SLV. And you'll notice that our trend lines our channel lines have changed over the past few videos. That is because the situation is fluid, and as we get more information, the channel lines are updated. And what do we want in channel lines? Well, we want them to be uniform. And if we get a massive move to the upside, massive move to the downside, and we can no longer draw them in a uniform fashion, we know that it is broken, and we start looking for another one. Now, at first glance, what do we see? Well, we see that the long-term moving averages are taking really good damage, and they're still there, but certainly taking massive damage. Short-term moving averages are headed down with strength, and we'll notice also that we have what is very possibly a excessive separation, which is typical when you break through a bar. Secondaries are very bearish, so at first glance this looks absolutely horrible. There's no denying that. Now, if we were to get an uptick, we know that our target would be right about 12,400. But we don't have an uptick yet. What we do have is a kiss of the newly formed lower channel line, which was established with this candle. And we're also below the Bollinger Band. So we should see a tick up or sideways to eject it from the lower Bollinger Band. Now, if this is truly a massive move down, it's not going to care, and it's going to keep doing what it's doing, and that should be very obvious to us over the next candle or two. Typically, however, when you penetrate the lower Bollinger Band, you have a reaction. You can see this one was significant, went up after that. This one was significant, had some indecision, and went up after that. Significant, up, significant, up. So, something to be aware of, and that would make sense if this is excessive separation, which it would appear to be. Now, moving on to the SPX, have our revised channel, and just like the Dow, everything looks pretty bad on secondaries. They do have room to move down, just like the Dow. They can stay down there for an excessive period of time, just like the Dow. And unlike the Dow, we are sitting on the lower Bollinger Band. We did pierce it, but we are just sitting on it. So, and if we were to get an uptick here, our target would be around 1325. So if we had had a big wick going through the Bollinger Band, you could say that significant break up, significant break up, significant break up, significant break up. But it doesn't have to be like that way, and it's not perfect, because as you can see here, significant break, and it continued down. So, and it's not a significant wick that penetrated it. So, you have that over here, and it did turn up even though it was red, but something to consider. Now, if we look on the weekly, we can see that we do have, the bears would like this. We do have some crossover on the short-term moving averages, and they are pointing down. long-term bar is in effect. Now if we do have complete crossover prior to entering the bar, we will have a target just shy of 1250. Secondaries have plenty of room to move. Also going to do that for the Dow. Look at the weekly, big red bar, continuation candle, and they are starting to cross over. And if we do have complete separation prior to entering the bar, we will have a target just shy of 11,600. Not going to pull any punches. That would be doing you a disservice, and being locked into any one ideology is just asking for the market to take your money. And you know, if we do get a bigger move down, you know, our channel lines are not going to make sense. That's what I was talking about earlier. Once they're no longer uniform, then we're done with them, and that's just how it is, and I think how it should be. Now, this isn't telling us too much, the Dow and the SPX. So we need something that's going to give us a clue. And here it is. We talked about in the previous videos that perhaps this is a head and shoulders, left shoulder, head, right shoulder has not exceeded the head. If it were to do that, then of course this doesn't work. But you know, and the secondaries are mixed up, down, kind of wanting to go up. But what do we see in the VIX that helps us? Well, we had a spinning top on Thursday, indecision. We have a bubbly looking short-term moving average crossing over and trying to make itself known. And we have another indecision candle. It's not perfect, like this one was formed perfect, but it is an indecision candle. But what does this tell us that is useful? Well, this may mean little or nothing, but we pierced the upper Bollinger Band. And on the VIX, when you pierce the upper Bollinger Band, normally you have a nasty reaction. Notice we didn't have that on any of these big up days, but we had it here and it dropped. Pierced it here and it dropped. You pierced it twice in a row, I'm sorry, 4 times in a row, and it dropped. Pierced it here and it dropped. You pierced it 3 times in a row here and it dropped. Pierced it 3 times in a row and it dropped. Pierce, drop, pierce, touch it, pierce, drop, pierce, drop, pierce, didn't touch it, drop, pierce, drop, pierce, 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 drop. So, what is the likelihood of it jumping through it and going on its merry way? Well, if history means anything, you know, it doesn't look good for the VIX. So that would be something to consider also. And you know, if the some news comes along, absolutely it can go up, push it up, and all that jazz. You know, you had that back here. It was relatively closed. Something hit, and it goes up and it pushes it up. So absolutely that could happen here, but I would say that odds are greater that whenever it has a reaction with the upper Bollinger Band, it normally is not good for the VIX. And of course, if that head and shoulders does pan out, We still have a target around about 11, what was it, 54, 50, yep, right about $11. So, and we explained that in better depth in the previous video about the lows of the VIX and what it would mean if that were to break. So anyways, there you have it. This video is already past 10 minutes, so I'm going to stop it and continue on the second video. As always, all investing decisions are your own. This chart and video are for entertainment, educational, and consumption of time purposes only.